So equity waterfall structures present a huge opportunity for real estate investors who raise equity from third-party limited partner investors to massively increase returns on their real estate investments. But if you're looking to raise capital for your first or next deal, choosing the right structure isn't always as straightforward as it might seem, and this process can end up being really complex with so many options to choose from and so many factors to consider. So in this video, what I wanted to do is simplify this process and break down 3 things to consider to make sure you're choosing the best equity waterfall structure for you and your investors if you're raising equity for your first or next real estate deal. Hey, this is Justin from BreakIntoCRE.com, and if you're new here on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first deal on your own, make sure to subscribe to the channel and hit the notification bell so you'll catch all new videos as soon as they're released. So if you clicked on this video, I'm assuming you have some sort of a general knowledge of how real estate equity waterfall structures work. But to summarize quickly, a real estate equity waterfall structure determines how cash flows are split within a real estate partnership. And if certain return hurdles are hit, the general partner, or really the managing operating partner on the deal, is going to receive a greater portion of the cash flows in proportion to their initial equity invested when the deal was initially acquired. And in the real estate industry, this additional cash flow is referred to as promoted interest. Now, on the surface, this can sound like a great deal for the general partner because this means that they're going to be compensated for the work they're doing by putting the deal together and making their investors money in the process. But what those return hurdles are and how they're calculated can vary a lot from deal to deal. And if you're doing your first deal with investors, it can start to feel pretty overwhelming to choose exactly the right structure that's right for you and your investors based on the deal that you're doing and the goals of the investment in the first place. So in this video, we're going to cover 3 ways to choose the best waterfall structure for you based on all the factors you need to consider when making a decision on this. So first and foremost, the first thing that I'd recommend when choosing a waterfall structure is to make sure that that structure is simple and easy to understand, especially if you're doing smaller deals and working with non-institutional capital partners. A lot of individuals who are investing passively in real estate deals don't have a solid understanding of all of the intricacies of different partnership structures, and the more complex you make things, the more likely you're going to scare would-be investors away and actually make it harder to raise the capital you need to close deals. We're living in a time right now where investors have more information and awareness than ever, and with things like Ponzi schemes and complex fee-laden investment vehicles, giving investment managers a pretty bad reputation over the last few decades. If investors don't understand something within an investment structure, they're probably just not going to invest in that structure at all. This means that while it might sound impressive to add fancy things like a clawback or catch-up provision into the agreement, clauses like these are also going to make it much harder for most individual investors to grasp what's actually going on with the cash flows and how their own personal returns are going to be affected, which is what they really care about. Now, when you do get into big transactions with one or more sophisticated institutional capital partners and you're trying to make a deal work, this is where some additional complexity might make sense, and that partner might actually introduce that within the partnership structure. But if you're looking to raise $25,000 to $100,000 checks from friends and family and other high net worth individuals, the rule of thumb is generally that simpler is much, much better. Now, aside from keeping things simple, you'll also want to make sure that your waterfall structure helps you as the sponsor and also your limited partner investors accomplish your investment goals that you set out to achieve when you acquire the property in the first place. And with that, the second thing I'd recommend when choosing a waterfall structure is to make sure that that structure incentivizes the sponsor to make decisions that align with investor goals of investing in the first place. So for example, if you and your investors are investing in a property to generate cash flow and you plan to hold that property indefinitely, something like a cash-on-cash based structure would incentivize the sponsor to hold the property long-term and take actions to increase the cash flow and investor distributions on a long-term basis. Or, for example, if a group of investors is acquiring a property to make a short-term profit and to recycle capital quickly, something like an IRR-based structure would incentivize the sponsor to add value, sell the property, and generate a profit in a short period of time. Or, for example, if a group of investors is looking for long-term appreciation potential and wealth preservation, something like an equity multiple-based structure might work well to incentivize the sponsor to generate cash flow for many years to come and to wait out a sale until a significant gain can be made after a 7 to 10-year hold period or longer. It's also important to note that these structures can be mixed and matched, meaning that you can have a waterfall structure with both an IRR and equity multiple hurdle, or a cash on cash hurdle and a separate cash flow split upon sale, or any other combination that keeps the original intent of the investment in the forefront when the sponsor is making investment decisions. Now, obviously, investment strategies can change over time to adapt to market conditions, but if you go into a deal with a structure that aligns sponsor compensation with the investment goals of the partnership as a whole, decision-making becomes a lot easier and more beneficial for all parties involved. And finally, aside from your terms being simple and your interest and compensation structures being aligned with investor goals, the final thing I'd recommend here when deciding on a waterfall structure is to make sure that whatever type of structure you're using, the terms that you're going to be using are going to be at market rates. So like we talked about earlier on in this video, real estate investors that want to invest passively have more options than ever right now, which means they have more information than ever on what they should be giving up from a cash flow perspective and what they shouldn't. Real estate investing continues to gain popularity as an alternative investment vehicle, and crowdfunding platforms like Realty Mogul and CrowdStreet are making it really easy for passive investors to not only have other options, but to see what market terms actually are for similar partnership deals. And when you're building an investor base, other firms can copy your strategy or compete with you in your target markets, but an asset that can't be duplicated is investor trust, which takes a really long time to build and very little time to lose. The bottom line here is if you can't back up the structure you're proposing, my recommendation is to adjust it until you can. Even though you might catch some unsuspecting investors in the short term, this is a really short-sighted strategy that's most likely going to lead to your investor base actually dwindling over time as those investors become aware of less costly similar investment options. If an investor has $100,000 they want to put in real estate each year, that might mean that they're only going to be investing in 1 or 2 deals on an annual basis. And if you're doing deals similar to other firms, just using a more dilutive partnership structure, that 100K is likely going to go with your competitor rather than with you. And this is actually true in my own experience as a limited partner investor, as an investor that partners with multiple different groups. So while I'm looking at a deal from a new sponsor, the fee structure is one of the first things I look at, and I passed on quite a few opportunities in the past because I knew I could get that same type of investment exposure with another equally as qualified team, but with a lighter promoted interest burden in the process. A waterfall structure is intended to reward a sponsor for exceeding investor expectations on a deal or exceeding what those investors would have otherwise been able to achieve in another investment vehicle with similar risk. And with that, if I'm a passive investor, I don't want the sponsor to take a portion of my cash flows for producing some sort of mediocre investment results that I could have achieved elsewhere, maybe with even less risk and more liquidity or a mixture of the two. Making it so that your return hurdles are high enough where if they're hit, your investor base is going to be happy is a good rule of thumb to make sure that your structure is creating a win-win scenario for the general operating partner and the limited capital partners as well. So overall, a waterfall structure that is simple, tailored towards investor goals, and structured at fair market rates is going to be your best bet to attract investor capital long-term to create a win-win scenario for both the sponsor and the limited capital partners on the deal. And if you're looking to raise capital right now and want to see how these different waterfall structures are going to affect your cash flows and how to model those in Excel, I'd recommend 2 Break Into CRE courses. The first is the Real Estate Equity Waterfall Modeling Masterclass, and the second is the advanced version, the Advanced Real Estate Equity Waterfall Modeling Masterclass, both of which walk you through many of the different structures we talked about in this video, like IRR-based waterfall modeling, cash-on-cash based waterfall modeling, or building out waterfall models based on multiple different return hurdles, like the IRR and equity multiple before any promoted interest is earned. And as always, if you want access to these courses and all other Break Into CRE courses on real estate, financial modeling, and analysis, make sure to check out Break Into CRE Academy, and I'll link that in the description below as well. So I hope that was helpful if you're trying to do your first deal, and whether you're an active investor or a passive investor, let me know in the comments below if there's a structure that you prefer and why you prefer that structure. And if you like this video and want to see more content like this on partnership structures and real estate equity waterfall structures, make sure to hit the like button on the video and subscribe to the channel so you don't miss any new content as soon as it's released. Thanks so much for watching. I hope you found this helpful in choosing the right structure for you, and I'll see you in the next video.